Well, good morning, everyone again. Thank you very much for joining us on this webinar on ESG impact investing. For those who don't know me, my name is Sebastián Roda, and I'm one of the directors of the CFA Society here in Uruguay, and I'll be your host today. As you know, the objective of our society has been to add value to our stakeholders. And in this line, a couple of months ago, we were very happy to announce this new partnership signed with M&G Investments, one of the UK largest asset managers. This alliance will allow us to provide high quality material and also contribute to the enrichment of our stakeholders, in addition to contribute to the financial education, which is also a very important objective for our society. So on behalf of the CFA Society Uruguay, thank you very much, M&G, for your trusting us. And I hope that this is the first event of many more to follow. So today I'm going to be your host for this discussion on a very relevant topic that has become even more and more relevant during the last years, with increasing global challenges like climate change, resource scarcity, new regulations, also combined with rising investor awareness. Sorry, there are. All right, I'm not sure if I lost you there. Okay, so all that combined, ESG and impact investments have become very important topics in today's portfolio management and security selection issues. So before I introduce our guest speaker today, just a little housekeeping rules. First, try to keep your microphones mute during the presentation. If you have any question during the presentation, please type them into the chat box for everyone to see, or you can send it directly to me. At the end of the presentation, we will bring them up and for a 5-minute Q&A session. So without taking more time, in order to jump into the topic, please allow me to introduce our presenter today, Ben Constable-Maxwell. Ben is the head of sustainable and impact investing at M&G. He's in charge of leading the M&G strategy on impact investment, as well as covering the sustainability issues like climate change and circular economy. Ben plays an active role as a member of several sustainable and impact investment initiatives, constantly interacting with companies and policymakers and NGOs. If I'm not mistaken, he has been working for more than 17 years at M&G. So we're very lucky to have him here today and be our first speaker from M&G. Without taking more time, Ben, thank you very much for being here today, and it's a real pleasure to have you with us. The mic is yours.
Fantastic. Thank you so much for the introduction, Sebastian. Can you just check, can you hear me okay?
Perfect.
Good, okay. Well, welcome everyone to this session on ESG and impact investing. It's fantastic to have you all on the call. This is a topic which we find, incredibly important, actually, increasingly as an investor in the UK and an investor globally. I've been, as mentioned, I've been at M&G for sort of 17 years now. And over that period of time, it's been really fascinating to watch the development of the ESG sustainable impact investing landscape. It's been a really really interesting period of time, and the acceleration towards the centrality of sustainable, responsible, and impact investing in the last sort of 3 or 4 years, maybe in particular, has been really huge, and it's been driven by so many factors. And today, what we wanted to do is give an introduction to you of the broad approach, how we think it can add value to an investment approach, how we think it's actually increasingly considered to be an important and crucial responsibility of long-term investors around the world. So hopefully we'll have a discussion. Please do share your questions, and we'll make sure we have a little time at the end to discuss some questions. So without further ado, I will try and continue through the presentation. There we go. Sorry. Okay, fine. So I think the background is really important here. The background to why responsible, sustainable, and impact investing, why ESG in general is becoming so important, is I think the scale of the challenges that are facing the world in a social and environmental context are just enormous, and I think they're getting greater and greater every year. And you know, we've set out a few of them on this chart here, but they're relatively simple, but they link to the availability and the scarcity of natural resources, how we are using those natural resources or failing to use them effectively and sustainably, and then all the knock-on implications and impacts and effects that approach takes. And so behind all of this, I think it is really crucial to consider those issues, those risks, and think about how the way they have to play a really important role in the strategy of investors, but also how important they're becoming for regulators, for policymakers around the world, and for consumers and citizens. So on the left there, the first point I think is that the population is growing very, very rapidly, and it's growing in certain areas more quickly than others, but that is creating kind of major blockages in terms of the availability and the effective flow of natural resources. It's putting huge pressure on the availability of scarce natural resources, and that can have a significantly negative environmental and social impact. One of the main impacts we think that is that scarcity of natural resources is having is the link to and the overuse of historically over many years of fossil fuels, and how that links in many ways to other factors. So carbon dioxide levels in the atmosphere are rising at an unsustainable rate. We believe this is pushing through a number of different planetary boundaries. That is having a significant impact on the availability and the importance of biodiversity, which is in many ways the foundation of the global and local economies. So deforestation is a very major issue. One of the key reasons why deforestation we consider, and climate change consider, to be such major issues is that they are so interlinked, and they are not just sort of dependent on each other, but they're also driving each other. So biodiversity is being driven by climate change, but biodiversity loss is being driven by climate change, but it is also contributing to climate change. And I think that places biodiversity and climate change at the real apex of the challenges that we face. But then that links to many other factors. For example, the economic and industrial system that we have to produce not just animal and food products, but all sorts of products, where we again are overusing those natural resources in a way that is genuinely problematic. And one of the interesting things that has sort of been highlighted by, I think, the recent COVID crisis is really that the depth of the interconnected nature of these issues. So there is, in many ways, the foundations for the current COVID-19 pandemic have come from the erosion of natural habitats, caused in turn by climate change, and the increased likelihood of zoonotic diseases, which then make their way into the human chain. So I think that the scale and the interconnected nature and the breadth of these challenges is really where we have to start. We did mention the fact that climate change is really sort of central among these challenges, and I think we all know the story, but it's important to kind of clarify and set it out. The history of carbon dioxide or greenhouse gas levels in the atmosphere has reached over the past decades really unprecedented levels, and that is placing a huge pressure on the global atmosphere and global the global environment. If we are to stay within the 1.5 degrees above pre-industrial levels, that is considered to be already a problematic level, but the level at which we can continue in a safe, productive and sustainable manner, we have to take enormous steps to reduce carbon dioxide emissions into the atmosphere from all sorts of areas, and we'll touch a little bit on those as we go through. But stepping back a little bit and saying what ESG means to us as an investor, and I think how important it is for all investors, we wanted to just set out on this chart the breadth and the range of different environmental, social governance issues. And on the chart on the left, and I think it's appropriate to think about an iceberg as an analogy and as an image. But the reason that ESG is so important to investors purely in an investment context is if you look at company analysis, you look at sort of research, and this is super relevant for the CFA kind of membership. If you look at analyzing companies, credit, equity, any aspect of our financial analysis, and only look at the purely financial or balance sheet issues, we think you're only getting a very small part of the picture. And it is all the other issues that are underneath the surface, if you like, that increasingly are driving business models, the success or failure of those business models, and increasingly financial and investment returns. So we think that the ESG factors are those that drive, in many ways, the long-term viability, success, or failure of companies. And so setting out a few of them of what they are here, just for clarity, and again, many of you will know this, but we'll just kind of wrap up quickly on this point. The environmental aspect is of course, it's climate change and greenhouse gas emissions into the atmosphere, but it is much more than that. Climate change has become the central issue, but there are many other issues that are long-standing in nature that investors need to take into consideration. And those include other aspects of pollution into the air, on land, and into the water. How companies manage their waste, how companies think about the availability of natural resources, the scarcity of those natural resources, how they manage that scarcity, and how they, for example, manage their businesses and their industrial processes in an efficient way that manages energy efficiency well. So these are all issues that on the environmental side, investors need to take into consideration, and there are many more. On the social side of things, it's very much about the kind of broad range of human stakeholders that companies have, not just the shareholders, but thinking about the range of other stakeholders. And they include customers, absolutely central. Employees is really probably the preeminent kind of range of stakeholders that most companies have. You have to consider and make sure that those individuals have decent working conditions, decent labor agreements, and a safe working environment, and ensure that they are being trained and developed for future success. And then the other aspect of the other stakeholder kind of group that we think is incredibly important are local communities. So whether you're a mining company or an oil and gas company or any other company, ensuring that you have a social license to operate from your local community can be the difference between success and failure over the medium and long term. And then governance really is the final part of ESG, but in many ways it is the central aspect. And in our mind, it is about identifying companies that have a clear leadership and strategy, strong oversight and governance over that leadership and strategy, and the right set of incentives in place to help companies drive the business in the interest of shareholders, but also those broad range of other stakeholders. So ESG really is the collection of issues below the waterline, below the tip of the iceberg, that really are crucial in building up a deep and holistic understanding of the companies or the investments that investors make. Now, something we think is important to consider, and it's a bit of a sort of concept that may or may not be useful at this stage, but I think it's important to introduce it. And this is really the spectrum of capital, which is a concept that investors increasingly are focusing on. And I'll set it out very briefly here, but it shows that right across the spectrum, there are different sort of aspects of sustainability, responsibility, and impact that investors can embrace. And on the far left-hand side here, you have the traditional kind of approach to financial services, to investment management, which really didn't take into account too much non-financial factors. It was all about focusing on the financial factors, and I think that was probably the history, to a significant degree, the history of our industry, and how, for example, the CFA kind of considered the role of investors and the role of investment analysis. Now, always there are other long-term factors to take into consideration, but the focus was on traditional financial analysis and not so much on other aspects of sustainability and environmental, social, and governance. Now, as you sort of kind of move down that scale and across to the right, you start bringing in ethical considerations, which are around screening out those companies, screening out those sectors that may be considered to be misaligned with the values that one of your customers, that some of our customers might be focused on. So screening out sin sectors, screening out controversial businesses. Avoiding harm is the way that we, in this spectrum of capital context, that is brought into play. Now, but then as you move further down the bottom and towards the right, you start recognizing that those environmental, social, governance factors that I touched on can really drive returns and protect value, as well as taking into account, beginning to take into account those stakeholders we mentioned. So ESG is a way to start merging the financial and the environmental, social, and governance. And then as you move towards sustainability, this is an area where really you're focusing on positive screening, you're focusing on sustainable, those companies that are focused on sustainable areas, which we believe will be the winners in the long term. That is starting to think about what are the solutions to these challenges, and then bringing that into your investment approach. And as we move to the right-hand side, this is very much about identifying those companies where you can measure the positive impacts that the businesses have. So moving from just avoiding harm to integrating ESG, and then focusing a little bit on the companies with really strong sustainability characteristics, right up to identifying businesses that, or investments that can clearly and measurably provide solutions to those challenges we set out at the start. Now, when you focus on impact investing a bit more specifically as the topic here, really it brings all of that stuff together. It identifies the scale of challenges that the world faces, whether it is global warming or pollution and waste, or biodiversity loss, or whether it is areas that are more in the social context, such as health, equality, poverty, and inequality. And impact investing suggests that these are challenges that governments have some responsibility to address, but importantly, private capital and the investment spectrum can also play a significant role in allocating capital to support public funding in the interest of finding and developing the solutions to those challenges. And importantly, I think, I spend a lot of my time thinking about, discussing, identifying investments where we believe they can make a positive, measurable, positive net impact on those challenges. And I wanted to introduce the sort of characteristics, the core principles of impact investing that the Global Impact Investing Network promotes. And again, I think they're important concepts to really get into one's head to understand how impact investing is a differentiated concept from traditional ESG or sustainable investing. And I'll quickly reference them here because we need to move on. But the concepts are intentionality, additionality, materiality, and measurability. And those are quite sort of unhelpful, not necessarily intuitive words, but in simple terms, it means identifying investments or companies which have a clear intention to make a positive contribution to addressing the world's major challenges, and to do that in a way that is measurable i.e. you can measure the positive impact that each of those investments is having, and is material. In other words, it is making a significant contribution to the challenge itself. So they are rather wordy concepts, but they're really important in helping to define what impact investing is and how the role of private capital can contribute to those solutions that we talked about. Okay, so I'm going to now step back a little bit and think about what are the factors driving this big change, this big shift. Why is ESG and/or sustainable and impact investing important? And those four broad areas, and there are many ways to cut this, but the four broad areas are the importance of regulation, the preeminent focus on climate change as a major global challenge, but also an interesting solution, the importance of shifting consumer or citizen preferences, not just in the goods and services that we buy at shops, or on the high street, or in the mall, but in fact in the financial services products that citizens are buying. And one of those aspects that I think is really driving a lot of this is the reality that in the past, whereas in the past there was a concern that investing ethically would naturally reduce your financial returns. I think it is being increasingly demonstrated by empirical studies and anecdotal evidence that financial returns do not have to suffer if you take a responsible and sustainable approach. In fact, they can be enhanced by taking such an approach. So the regulation side of things, and I'm afraid I'm not going to deal specifically so much. Maybe this is a CFA Institute discussion we can have towards the end. But the drivers, and I'm using Europe as one of the kind of focuses here. But globally, regulation and legislation towards ESG is really picking up steam hugely. Now, the chart here sets out a very, very long-term perspective on that. And it cuts off just towards the beginning of 2019. We're looking to get this bit updated. But the raft of regulations pushing companies and investors to disclose more, to be more transparent, and to be more effective in managing their environmental, social, governance, sustainability risks is just ramping up very, very strongly. If you went back to the sort of the 18th or the 19th centuries, but also the 20th century, you can see the strong trend towards growing. But in the last few years, those regulations have ramped up. In Europe, we really are, there are so many regulations coming our way, both as investors, but also on the companies that we invest in to improve disclosures. But it's not just a European consideration or context. Right around the world, we're seeing an appreciation by regulators and policymakers that climate change is a genuinely huge risk that we all face. Inequality is a major factor that we need to consider. And pollution is a huge risk to the health and well-being of our global societies. So regulators are taking significant action, and that is massively driving the uptake of sustainable and responsible ESG investing. As I said, I think Europe is taking a very strong stance on this. This is something that, Energy is headquartered in London, but obviously we have operations around Europe and around the world. But for us, the EU regulatory framework is really driving things very strongly. And as I said, I'll pick a couple of points that I think are really interesting. But the sustainability disclosures regulation is really forcing investors to tell, or fund managers to tell our clients how we are managing their investments on their behalf with responsibility and with sustainability considerations at the heart of what we do. There is regulation coming at companies as well, whereby, for example, the taxonomy regulation will have to set out whether a company's business activities are contributing positively to addressing climate change or contributing negatively to the problem of climate change. Now, there are all sorts of other factors around labels, green bond standards, non-financial reporting for companies and for investors, but it's a very, very fast-growing agenda, and it's here to stay. This is not something that we believe will will go away in the years, months and years to come. This is here to stay, and it is a big influence on us. So climate change is the next factor. Now, every year the World Economic Forum, the WEF, puts together at the start of the year or towards the start of the year the main risks that it sees to the global economy. And if you went back a number of years, those risks tended to be kind of business, economic, let's say political in nature in many ways. But as the sort of last 3 or 4 years have progressed, the focus on environmental issues has really ramped up. And in fact, now the top 5 risks that the World Economic Forum, which is not just it's not an environmental pressure group. This is the most influential group of business leaders and policymakers in the world. They are all defining and identifying climate change and related factors, so extreme weather, failure to act on climate change, the links to biodiversity loss, natural disasters, etc. These are now the top 5 risks driving the global policy agenda. And I think that tells you all you need to know about how important climate change is as a driver for businesses and investors. So now consumer preferences, it's really interesting. You know, when I started working in ESG about 10 years ago, the discussions we had with our sort of more financial advisors or retail-oriented investors were really that they were just interested in the financial returns. And obviously they were ethical people who had concerns about society, but those concerns never really made their way into the financial considerations. So, and when he spoke to institutional investors, clearly there was a bit more of a focus because it was part of their job to think about sustainability and risk and ESG. But again, the focus was very much about the duty to deliver long-term financial returns. And what's really fascinating in the last few years is that there's been a very, very major shift towards the recognition that individuals, whatever age they are, want their fund managers, their investors, to look after their interests, not just financially, but also from a sustainability and societal point of view. So the 2 charts here are a really interesting survey that took place from Morgan Stanley. Some of you have probably seen it. But really the question was, how important is or how interested are you in sustainable investing? What do you want to see from the fund providers that help you kind of deliver your long-term investment goals? And on the left, you can see, maybe not surprisingly, that with an increasing trend, but already quite high in 2015, but by 2019, 95% of millennial investors were very or somewhat interested. Now, people often say, oh, this is great, but it's just a millennial issue. And what's really fascinating, I find, is that if you look on the right, across the broader general investing public, actually 85% of investors were somewhat or very interested. Now, these trends are rising, and it's not just a small pocket of millennial investors, it's actually the general investing public who wants their fund managers to act responsibly on their behalf. And also wants them to deliver sustainable products for them to invest in. Okay, and then now the final point, I think, is really one of the most fundamental ones, and this is really crucial. And this is that, again, the view in the past that sustainable, ethical, positive impact investing necessarily resulted in a lower return. That view, I think, has gone out the window. There was a really good example in 2015 of a group of academics teaming up with Deutsche Asset Management, and I think it was the University of Hamburg, who pulled together more than 2,000 studies from between, I think it was 1975 and 2014. And looked at those studies, and the studies were assessing the link between companies with strong ESG credentials and resultant financial performance. And it's fascinating that 90% of those studies showed that companies the more sustainable companies delivered better financial performance than those which were less sustainable. That's one of many studies, I think, that is beginning to show or point to the fact that strong ESG, strong sustainability It does not mean lower returns. In fact, it can lead to better risk management, better informed investment decision making, and we think better long-term returns for your investment portfolios. Okay, so then the final point here is this is a trend, and many of you will know this again, that the PRI, the UN-backed Principles for Responsible Investing, which was set up in 2006 to help steward and drive the world towards more greater sustainability and responsibility in the investment in the investment industry. It's been one of the great success stories, I think, of the last decades, and it's been a very major driver in ensuring that investors right across the spectrum need to demonstrate their responsibility. There are six recognized principles around embedding basically environmental, social governance considerations into your investment approach, into your stewardship approach, into your investment analysis, and then promoting these responsible principles around the world as a signatory. So you can see there the very, very fast growth, and by 2020, I think it was sort of more than $100 trillion of assets under management that are now signed up to the UN-backed Principles for Responsible Investment. So to pull that together, we believe very strongly that ESG is not a fad. It's not something that is a short-term trend. It is absolutely the future of investing. We believe it's more than just ethical investing, but ethical investing is an important aspect of it, but it is broadened out to be much more about integrating material risks into your investment approach, and then investing in those areas that we believe will benefit from long-term sustainability trends. It's not just a process, it's not just a type of fund, although ESG funds are really an important part of our responsibility to deliver to our clients, but actually ESG is a process. And as I said, ESG really does support long-term, better informed investment decision making. So I'm going to say a few words now finally in the next 5 minutes or so just about ESG at M&G. Just checking up on my timing, see how we're doing. I think we've got about 5 or so minutes left. So yes, I mean, going back to that ESG how the UN-backed Principles for Responsible Investment, the PRI, every year we have to fill in an annual survey on how we are implementing our ESG strategy, not just across the organisation, but actually across all our different asset classes, whether it's equities, fixed income, real estate, alternatives, and infrastructure, for example. And so we fill out the survey. It's a lot of work. Many of you on this call will no doubt be filling this out. You do it in the first few months of the year, so it's coming up if you haven't done it yet. But you can see the scores you get, and I would just quickly say M&G has been doing this as a signatory since 2013, and we do score strongly across all asset classes with an A+ as our overall score. For us, that's an important sign that we're doing the right thing and we're on the right path, but we always believe we can improve, and so a huge amount is going on at M&G all the time to try and improve our ESG standards and our products that we have available to our clients. Over the last few years, we think our ESG program has accelerated. We are doing more and more to provide the tools and the data and the insights to fund managers, not just in the ESG sustainability team, which I sit in, but actually to fund managers and analysts on their desk. So we have now dashboards with ESG data, pulling together various sources of data that now sit on the fund manager's desk that can help them understand and analyze the risks and the opportunities that their companies face. Importantly, we think that it's crucial to align those data sets and tools really deeply into the investment approach, rather than just having as an add-on. We're focusing more and more thinking out big major thematics, where is climate change or palm oil or cybersecurity or circular economy, deforestation. That's absolutely crucial. We spent quite a lot of time about designing our data sets using, for example, the Sustainable Accounting Standards Board, the SASB, which helps us identify for every sector. We looked, if you go back to the start of our presentation and looked at that that chart or that image that showed the iceberg, all those ESG issues that are not always entirely relevant for every single company. So we need to focus on materiality to help understand and help our investment teams understand what are the most relevant issues for each of those investments and sectors. And then as we go forward, we spend a lot of time increasingly focused on climate change. We've developed a very in-depth climate change engagement program to identify the key risks for our investments, and also to invest in solutions to climate change, which is probably the very last point there, with the recent launch of a climate solutions fund to support our other positive impact funds we've been running for a few years. And yeah, I think kind of we'll jump through a couple of these slides, but really this highlights that our ESG approach is a dual focused approach. The first part is to make sure that ESG is integrated on the top left there into all of our funds, whether they are fixed income, equities, real estate, or infrastructure alternatives. And then importantly, to support that, we have been designing and developing an increasingly large range of products across equities, fixed income in particular, but also real estate and other areas that are designed to deliver outcomes to our customers, and sometimes societal, social and environmental outcomes on those challenges. We see the ESG program as having three pillars. It's partly about this integration into our research. So we really think that it's not just about scoring, it's actually about developing a deep understanding of the issues that each company and sector faces, and then pulling that into a scorecard that can sit on the desk of the fund managers, as we said. It's very much about educational development though. So we spend a lot of time as a sustainability team, but also tapping into external perspectives on building and driving our understanding of these environmental social governance issues higher and higher. And that's a long-term commitment, but it provides us great insights, and hopefully that's helping. And then the engagement side of things I mentioned is really crucial. We think it's not just our responsibility, but it's actually part of we think it drives improved returns. Again, there is strong and really interesting evidence from, for example, the PRI that shows that those investors that engage on relevant issues to the company that is the target of that engagement can actually drive higher returns through that engagement process than if they didn't engage. So, we think it's a holistic approach about improving the quality of information, ensuring that's accessible to the teams, but also driving your returns higher and your responsibilities, carrying out your responsibilities in more of a deep way by voting and engaging with the companies that you invest in. One of the, I think, big picture steps that M&G took towards the beginning of this year was to set out, recognizing the responsibilities from a climate perspective, was to set out our ambitions as an asset manager and as an asset owner and as a company to address the climate crisis by reducing our emissions. So we have a net zero ambition as an organization to get our organizational greenhouse gas emissions to net zero by 2030. And then across our whole investment suite, we have a commitment to get those down to net zero by 2050. And we are developing internally a very detailed action plan to help us engage with companies, reposition our portfolios over the long term in a balanced and pragmatic and measured way, but also to invest in those companies that are providing solutions to climate change, among many other issues. And then maybe kind of finally pulling it together, we have this a range of funds which contribute to these areas. We break them down into a couple of different ways. All of our funds at M&G along the bottom there we commit to being ESG integrated. In other words, ESG is a structured part of the investment approach, in the belief that that helps to drive better returns, but also helps us to fill our responsibilities. We have a set of funds across in the bond space, but also in the equity space, where we are designing funds that have extra elements of ESG, whether it's extra exclusions or positive tilt towards better performing ESG companies. And then we have a sustainable range, which is multi-asset in nature, where we, again, really focus on driving sustainability and ESG high standards into our investment approach across asset classes. And then at the top there, one of the funds we've just launched isn't mentioned yet, but our positive impact range, where we have a climate solutions fund as well. For us, that's a fund range that really is designed to help address the world's major challenges by investing in the solutions to those challenges. So I think I've run up against time now. I think we've had, my alarm clock just went off. That's 40 minutes. Hopefully that's been of help, and I'd love to see if there are any questions. Very happy to answer any questions the audience may have.
Great, thank you very much, Ben. So yes, we actually have a couple of questions. So the first one is from Andres. He says that many papers here indicate that ESG indexes not having performance difference versus broad market indexes, at least not being statistically significant. Are you aware of the opposite taking place for non-ESG stocks? In other words, does not being ESG leads to positive alpha or stronger results?
Yeah, so I mean, I'm mindful of laying too much responsibility at the feet of ESG to guarantee sort of longer term returns. Now my experience and the evidence from a broad range of, for example, that statistical study that the University of Hamburg and Deutsche Asset Management kind of highlighted was that there was a sort of very limited negative correlation between strong ESG companies and subsequent financial returns, and net there were 90% of those cases, of those studies in this meta study that highlighted a positive link between strong sustainability characteristics, strong ESG, and resultant financial and operational performance. Now, my view, therefore, is that actually there is kind of increasingly strong evidence that ESG contributes positively to longer term investment outcomes. Now, at any period you want to look at, one can have a sort of a stronger or lesser view there. And I'm also mindful that, as you say, if you purely take an ESG index and then, for example, adjust for size or regional or sector biases, then you're right. Then it may be the case that there isn't sort of statistically significant evidence to show that ESG on its own drives returns. But I think those companies that are demonstrating stronger ESG characteristics and also are operating in sectors where those ESG characteristics are stronger than in some sectors. Our view is that there is clarity there, and that clarity is building up. And as I said, the other point is that when you use your engagement and your voice to push for change in more of a beta way, then actually that can further improve the outcomes from a financial point of view. So, I think it's a tough one. I don't think we'll get to the answer in this particular discussion necessarily, but I would say there is very little evidence that ESG reduces your returns. I mean, I think that question really has genuinely gone out the window. And the final point is that I think when you are an active manager focusing on really high quality businesses where ESG is an indicator of that, and you're also investing and you are engaging with those companies to drive further improvements, I think the statistical evidence suggests that is actually a very value adding and alpha generating approach.
Great, thank you. I have another question here. So he says, okay, so he says that the information disclosure across companies, segments, or even countries is not consistent or even homogeneous. Moreover, if you analyze like non-traditional markets, like emerging markets or Asian, like ESG information is really tough to get. How should we treat those information gaps?
Yeah, well, I think two things. One is we need to push for better disclosures across the piece, and I think kind of global regulation, regulation and legislation is pushing for that. I mean, we're doing it across Europe, and I think that is being picked up and to some degree embraced around the world. For example, you know, taking local leadership. China, for example, has come out with these sort of ambitious climate targets and will be using disclosure to push for changes in China, and I think that will have a sort of positive impact on the rest of the region. But you know, it is the reality of things. So I think we have to deal with the fact that even if we push for change using regulatory tools, but also investor engagement to push for those changes, that will take some time to come. So I think what one needs to do as an investor is to take into account the heightened risks that maybe are represented by weaker disclosure in certain areas, but really to focus on the material issues that that company is facing. And in the same way that we would invest in any emerging market or any market where disclosure levels are a little bit lower, I think we need to focus on the key issues, try and understand them as well we can. Increasingly, the tools and the data from some of those third-party data providers covers emerging markets as well as developed markets, and so I think we have a good level of understanding, but we need to improve it, and I think we need to use our voice and engagement, and hopefully regulation pushes for improvements at the same time as well. But it's a good point. There is a gap. Investors often have to deal with gaps, and I think this is one gap that investors have to deal with, and I think that gap will close, and it's closing pretty fast in my experience.
Excellent. All right. So, okay, I think we don't have any other questions for the moment. So, no, nothing here. Okay, so, well, on behalf of CFA Society, Ben, I wanted to, thank you very much for all this insightful presentation. I think that, yes, you mentioned like this year with the COVID-19, it has really shown the importance on several ESG issues, and also the importance that we as individuals and as professionals, we have to take action to all these challenges that we face. So again, Ben, thank you very much for taking the time, and it's been a real pleasure to having you with us.
Pleasure. Thank you so much for having me, and good luck, everyone. We'll see you again.
All right. Bye-bye.
Bye-bye.